The highly anticipated India-US trade deal has kept the business world watching closely, but the outcome might matter less for India than many think. Why? Because India is not betting everything on this one trade deal. Services exports are soaring, according to an SBI research report. They are expected to touch $387.5 billion this year, thanks largely to booming sectors like IT, finance, and business services. That alone gives India significant insulation. Now, let's shift to goods. India holds a clear edge in chemical exports, a key category for the US. With countries like China and Singapore now facing steeper tariffs, India has an opening to expand its footprint. Analysts suggest that capturing just 2% of their market share could give India's GDP a 0.2% boost. Add another 1% from countries like Japan, Malaysia, and South Korea, also facing elevated tariffs, and the GDP gain climbs to 0.3%. A similar opportunity exists in apparel exports. India already accounts for 6% of US apparel imports. There's potential to edge out competitors like Bangladesh, Cambodia, and Indonesia. A modest shift, say an additional 5% market share, could add another 0.1% to GDP. But India is not standing still elsewhere. It's actively reviewing its ASEAN trade agreement to plug tariff loopholes that have allowed Chinese goods to flow in largely duty-free. Trade with ASEAN has already reached $123 billion, and there's scope for India to not just increase exports but also safeguard its markets. Meanwhile, Trump has been sending updated tariff letters to more than 20 countries. Some have seen relief, others higher tariff rates. India, notably, has not received a letter yet, a possible sign that a deal is within reach. On its part, India has already submitted a final offer, covering goods trade worth $150 to $200 billion. Contentious issues like agriculture and dairy may be set aside for now to avoid further delays. However, there's a wrinkle in the story: the energy sector. Trump has just rolled out a 100% tariff on Russian exports, including oil. And here's the catch: secondary tariffs on countries buying from Moscow. These would kick in after a 50-day deadline for Moscow to end the war with Ukraine. Today, India gets about 1/3 of its oil from Russia. Before the Ukraine war, it was buying almost none. That cheap oil has saved billions, but it could soon come at a high cost. Reports suggest these secondary penalties won't just hit specific companies, they could hit India's entire merchandise export ecosystem. It's been cheap and helpful, but the savings might not be worth it anymore, because these new US penalties could hit all of India's exports, not just oil. And if that happens, India would have to shift back to West Asian suppliers or newer players like Brazil. The price tag? About $4 to $5 per barrel higher. But Energy Minister Hardeep Singh Puri says global supplies are sufficient and oil remains stable at $65 to $70. So, India may stock up on Russian oil before the deadline, while quietly setting up backup sources. Meanwhile, India's final trade offer, covering $150 to $200 billion, is already on the table. Some sectors like agriculture and dairy may be left out, and that's by design. So, deal or no deal, India is playing the long game, diversifying, hedging, adapting. It seems India's trump card in tariff war is refreshingly old school. Don't put all your eggs in one basket.